On today's Rice Report, I am joined by George Gammon. He is the host of The Rebel Capitalist and the YouTube channel George Gammon. If you're not already subscribed or following George Gammon, I definitely encourage you to check out his channel. I'm going to have links down below and above. And also, speaking of, this happens to be your first time ever watching any of my videos. I definitely encourage you to explore my channel. Make sure you're subscribed, smash that like button, hit the notification bell if you want to stay up to date with my videos as they come out. I encourage everyone to check out my Patreon channel where I post up exclusive content and it's a way to support what I do directly. Follow me on LBRY where I post up extra videos. Check out my audio podcast, Rice Radio, that is available on anchor.fm, hosted on all major podcasting platforms at Rice Radio. Also, if you're interested in buying any gold or silver, I recently have partnered up with moneymetals.com. If you're a first-time buyer, purchase $100 or more and use the promo code RICE, RICE, you're going to get a free ½ ounce of silver. And it's another way to support the channel as well. I'm going to have links down below for everything I just mentioned, as well as everything we talk about today. And we're just going to go ahead and get right into today's report. All right, ladies and gentlemen, at the beginning of the video, I mentioned today joining me is George Gammon, somebody who I look up to, who does a lot of really great economic work. He is the host of the Rebel Capitalist Show. He is a self-macro addict, entrepreneur, investor, and real estate expert. George, I really appreciate you coming on the show today. How are you doing?
I'm extremely well. Thank you for having me.
And I really honestly do appreciate you taking the time to do this. I mean, I do look up to a lot of the work that you do. You're a great economist. I like your macro work. More recently, I've been really enjoying your whiteboard videos a great deal. I like how you've been trying to explain other people's perspectives from like a devil's advocate point of view, and also trying to break down a little bit of the Federal Reserve and what's going on with their shenanigans. So yeah, it's an interesting time to be alive.
It really is. It really is. And I always like to point out that I'm definitely not an economist. I almost flunked out of high school. And I've never taken an econ class or a finance class in my life. I'm just someone who, I retired in 2012. And when I retired, I needed to figure out just how to invest my own money. And that kind of led me down the rabbit hole. I stumbled upon Milton Friedman, Thomas Sowell, and then, as far as economists, and then macro guys like Jim Rogers and Peter Schiff and Rick Rule. And then I just absorbed so much of their content that it just became an obsession and just a passion of mine. So that's kind of what brought me to where I am today. So it's all just self-taught. I think that's a good lesson for everyone out there that might hear someone talk about quantitative easing or the repo market or the Fed's balance sheet or bank reserves or the euro dollar system. And they might just think that it's above their pay grade and that there's no way that they'll ever be able to understand it. But that's just not true. Once you start to understand the terminology and just think it through a little bit, it's very easy to understand. And I think it's something that's very necessary for people who want to take more control over their financial future.
Right. No, that's so well said. I mean, obviously, I would say that you're very humble because you have learned a lot and you have become somewhat of an economist. And like you said, it doesn't take going to school to learn these things. In fact, you really wouldn't learn these things in school because
that's right.
I went to school several years ago.
You learned the opposite.
Right. I went to school for business administration, and it was what I was learning that was conflicting with the other things I was learning that made me say, whoa, hold on here. Someone's not telling me the truth. And I started to realize it was actually the education system. So
that's right. That's right. I always say I'm not part of the Austrian school of economics. I'm not really part of the Keynesian school of economics. Just the economic school of common sense is what I try to stick to.
I love that. That's good. That's a good way of putting it. Well, the reason I wanted to bring you on is because, I would like to say, even with my limited knowledge, and I like the way that you said anybody can learn this, because I'd like to put myself as an example of something like that. I'm not an expert below your pay grade, and I know that there's people above your pay grade. So it's just being able to learn from one another and being able to have good conversations and dialogue that help to challenge our minds and help us to think a little bit more outside the box and kind of get away from that mainstream narrative.
Yep.
In my mentality, I feel like where we are now, everything that we've experienced just this year. I mean, we can kind of go back, obviously 2008, and then last year in 2019, we saw the inverted yield curve. Then we saw the repo market issue going on towards September, October of last year. And then we had the convenient COVID, which became a scapegoat for everything that took place prior to, as if we had no economic problems prior to this this pandemic, and then all of a sudden it's a scapegoat for everything. And now we're in what I'm calling uncharted territories. Nobody really honestly has a clue of what's going on. Even the Federal Reserve and every big economist themselves. I mean, I think people are speculating now. So having people like you on the show kind of gives a different point of view for where people feel like we're headed. So I'd like to kind of get your point, man, like, you know, where you think that we are now with everything happening with the Federal Reserve. How is just in America alone, how is our economy right at this very moment, with the fact that we have all-time highs in stock markets and record number of unemployment all at the same time? Like, what does this spell out to the average person?
Well, I think the average person, I'm going to say, has a 401k, has an IRA, doesn't really understand what a lot of this means, but has a feeling that something's just not right when they turn on the news and hear that the Federal Reserve has printed another $3 trillion, or that the deficit this year in the United States is projected to be over $4 trillion. Some estimated around 3, some estimated over 4. But the bottom line is the deficit that we will have this year in the United States, meaning the additional debt that is going onto the balance sheet of the federal government just this year, exceeds the total amount of debt that the United States government had from 1776 to about 1990. So you think that's almost, let's call it 200 years, right? A little more than 200 years. It took the United States to get up to, I would say, 3 trillion in debt, just to use round numbers.
Right.
And this year alone, in 1 year, we're adding more than $3 trillion in debt to the balance sheet. So when people look at that, they're like, okay, something's not right there. So we'll just use that person, or that example person, as kind of the average Joe, let's say.
Okay.
So I think the average Joe needs to understand that there's a total disconnect between the stock market and the real economy. And I think we've been led to believe, rightfully so, that the stock market is a reflection of how well those companies are doing. You would think that if those companies are doing better, then there would be more demand for their shares because of future profits increasing, and therefore those shares would go up. That's kind of the way it worked in the 50s, 60s, 70s, 80s, and I would argue maybe even into the 90s. And it's just, it's got almost like this brand attached to it that people just, they make the connection and they don't really question it. And I think that's why Trump especially goes on and on and on and on and on about the stock market, because he knows that's kind of the lowest common denominator that as far as this pitch that he can use to get people to believe that everything is fine, right? But then when you start looking at the underlying fundamentals of those economies whose stock prices are going up, or the underlying fundamentals of the actual businesses, their profits, their their balance sheet, then you say, wait a minute here, this company can't be worth a 40 times multiple or even more when they've never even made a profit. Like, how can you determine what their multiple is if they've never made a profit? And I know some people would argue, well, it's a growth company and that's different. Well, okay, that's fine. That's not really how I like to invest. But I think that although that may be true, that there's growth companies out there that would justify a certain multiple, the average person doesn't understand that. Like, the average person doesn't understand that Tesla has never made a profit.
Yeah, I learned that in business school, and I was like, and that kind of floored me, because I'm like thinking, this is a company that I have heard to be successful, but most of the time you would relate success to profit, and and think, but I understood the long-term growth model, but I get your point. And Tesla is a great example. I was thinking that when you mentioned it.
Yeah, and I'm not here to bash on Tesla or say that it's a bad company or the share price is this or that. That's a completely different discussion. I'm just saying that when most people go out there and see Teslas on the road, when they're driving around in Southern California, they just automatically assume that they're just making boatloads of money because you drive down a street and there's two Teslas in the parking lot or the driveway, you know. So that's a real big disconnect. So I think most people need to look under that layer first and foremost to determine whether or not they're taking too much risk with what they own in their 401k. And the same thing goes for housing, because the majority of Americans have, I would argue, and I think the statistics would bear this out, probably at least 90 to 95% of their net worth in a combination of their 401k and the equity in their house.
Yeah,
and assuming they don't own their house, let's say they've got 50% equity. Well, if the market goes down by 50%, like it did in between 2006 and 2012, well, now all of a sudden you're completely wiped out. And if the market goes down and stays down for a long period of time, then you're wiped out. And a lot of people say, oh, George, it's never going to happen. Well, okay, well, let's look at Japan from 1990 to call it 2005. Well, let's look at their stock market. Let's look at their housing market. Those are markets that went down, continue to go down, and never recovered. The same thing in Europe from 2000 to 2015. So it's very possible for this to happen in different markets around the world. The United States doesn't have a monopoly on asset prices always going up. So you have to take that into consideration to make sure that you're properly diversified. So if we do have a downturn that's sustained for a long period of time, that your purchasing power long term isn't going to be overly impacted. And I think it goes back to education and understanding that those fundamentals that that should be driving the market are actually quite poor. And I don't think it takes, especially now, I think that's pretty obvious when people walk down the street and they see all these restaurants closed. I mean, I know even anecdotally, I went out for lunch yesterday with a friend of mine, and we went to, a place that's pretty darn busy here in Phoenix, Arizona, as far as this strip mall or this area of town. Mm-hmm. And first restaurant we went to, oh, that looks good. Let's go check that out. Closed for COVID. Yeah. Next restaurant we went to, oh, that looks. You're just looking at the sign. Closed for COVID. I'm like, okay, well, this is not a good sign. And then people also need to understand. I remember hearing back in March and April that, oh, well, if the economy could just get back up to, let's say, 75% of its output that we had prior to going into COVID, okay, at least that would be something, and that's good. That's not so bad.
Right.
But what people don't realize is that if we took the economic output of the United States down by 6% to 94%, that gives us the GFC that we had in 2008. If you take economic output from 100% down to 75%, meaning it goes down by 25%, that gives us the Great Depression. Mm-hmm. So people were sitting there saying, okay, well, if we could just get back up to this level, we'd be okay, not realizing that if we were able to get back up to that level, we would still be in an economy that was the exact same as the Great Depression of the early 1930s. Wow. So how does this happen? I think that's the important question that people would have. How does the stock market continue to go up and up and up and up every single day to all-time highs when the economy is struggling, to say the least? Well, what happens there is it's all about liquidity and capital flows. So if there's more currency units that are being created, and those currency units or purchasing power is going into stocks, regardless of the fundamentals, right, the price is going to go up because it's simple supply and demand. And passive investing is a great way to, I think if you understand how passive investing works, you can easily understand why there is such a disconnect between the stock market and the real economy, and therefore the risks that you may be taking with your 401k, your IRA, or maybe even the equity in your home. So the way passive investing works, if you have a passive index fund, is there is no fundamental analysis. None. Zero. The only thing that determines whether or not they buy a stock is if they have a dollar that comes into the fund on net, then they have to buy. If they have a dollar that goes out of the fund, then they have to sell at any price. So you could sit there and say that, you know, Tesla is wildly overpriced and it's going to crash and all these things. But the index fund manager never considers that. They don't even care about the price. They pay double what the.
You froze up there on me. Hopefully I didn't lose you. I mean, I thought it was honestly something on, because I've been having a lot of issues. I've been having a lot of intense conversations with people, and you know, when I start talking about the Federal Reserve, sometimes I question whether or not
the NSA did it.
At least it was your phone overheating.
Well, maybe they made my phone overheat. Maybe that was just
well, putting extra processing power on your phone would definitely do something like that. So it's not, I mean, I don't try to sound like a complete paranoid person, but I don't put things out of question anymore, not these days. So go ahead and continue where you left off, and I appreciate you reconnecting.
Yeah, so going back to how the passive fund works, I think we're describing that. It's basically that a dollar comes in and they have to buy, a dollar goes out, they have to sell. So if you have net inflows to passive, it just doesn't matter. The prices just go up and up and up, and they can go up almost infinitely until there's just net outflows. And so if the Fed, or I don't want to say the Fed because that people get confused. They think that just because the Fed prints money, and what's interesting about the Fed is they can't really print money in the sense that people think. They think the Fed prints money that just goes directly out into the real economy and chases goods or services. It's not really true. The Fed can really, as of right now, can only create bank reserves. And that's not exactly the same thing as printing money. So they can create bank reserves and buy treasuries, let's say, from a bank. And that gives the bank's balance sheet additional capacity to create more loans.
Right.
And then they can loan the money to, let's say, a hedge fund, and then they go into the market. What the Fed does is they play a game of expectations. It's more of a psychological game. So when there's let's say a quote unquote Fed put, that Fed put, I don't necessarily think that it's mechanical. And I think a lot of people, like my good buddy Jeff Snyder, would argue that there really is no Fed put. It's just their psychological games. And this would make sense because they always talk about trying to achieve a 2% inflation or this inflation or that inflation. Well, they've been talking about this since 2008. So if they're so good at micromanaging the economy and micromanaging even the increase in money supply, chasing goods and services, well, then how come it's taken them 12 years and they still can't hit their inflation targets? Now, I would argue that the CPI is not really a true reflection of core CPI or of the actual inflation rate. But that's a whole different topic.
Yeah, but don't they have an excuse for that now? They put out that monetary policy change where they're going to be letting inflation kind of go above the 2% mark for whatever time period.
Yeah, but they can't even get it to 2%.
Right,
using their measurement. I would argue that it's a lot higher than that.
Exactly.
Using their measurement, they can't even do it. So they're probably just understating the inflation rate and then just running it high to increase tax receipts. I mean, that's the end goal, is just to increase tax receipts going into the United States government. People say that, I think most people understand why inflation is good if you're someone that has debt, and that's because it lowers the value of the debt. So you're paying it back with dollars that have a decreased purchasing power. That's only true if your income rises. So the inflation is only a benefit to the federal government in the sense that it lowers their burden of debt if the tax receipts increase.
Okay.
If the tax receipts don't increase and inflation still goes up, then it exacerbates the problem because everything that the government buys goes up, but yet the tax receipts go down. So it's not, there's a causal effect there. There's a lot of moving parts, but it's really something that people need to think through. And it just goes right back to the beginning of our conversation. That when you're talking about the stock market being disconnected with the economy and the national debt and how inflation affects that, those are the two things I'm referring to, that people, I think it would really behoove them to think those things through and get a good understanding of how they work.
Well, okay, so let me ask you your opinion on where we're at right now. With all the money printing that's going on, the talks of the possibility of the dollar losing its world reserve currency status, I don't really think that we've even experienced any of the pain from all of this money printing yet. Would you say that that's a correct statement? Like, we haven't seen any kind of inflationary events like take place. Do you see us going into a potential hyperinflationary event? Do you see us losing world reserve status? And if we do, like, how does that affect the everyday person here in the United States?
Yes. So to answer your question as specifically as I can, I agree. I don't think that the United States, the average American, has felt the pain of this excessive, let's say, expansion of base money, and that at some point you're going to have to pay the fiddler. As far as the world reserve currency, it has allowed Americans to wildly overconsume. And what that means for the normal person is your standard of living and the standard of living of everyone around you would be far, far lower if the United States, let me say this carefully,
okay,
if the United States would have had the reserve currency and if the economy would have gone down the same path. See, that's the caveat there, that there's nuance. And what I mean by that is, if the United States never would have had the world reserve currency, the world reserve currency might not have affected our economy detrimentally. Therefore, now we may have an even better economy if we never would have had it. You see, and why I say that is because it's all about manufacturing. We don't produce any stuff.
Not anymore. No.
And the reason we don't produce any stuff is because we don't have to, because we've had the world reserve currency. So that's why people and the average American can overconsume and have a much, much higher standard of living now compared to the amount of stuff we produce in the United States, where in another country that just would not be possible. But is it a benefit? It's only a benefit from the standpoint of if we would not have depleted our manufacturing base by obtaining the world reserve, or by not retaining the world reserve currency. You see what I'm saying?
Yeah.
So if back at, let's call it Bretton Woods, if we still would have gotten rid of our manufacturing core, then yes, we're far exceeding our standard of living. But if we would have kept that manufacturing base, and I don't know, it's a very kind of an interesting thought experiment.
And we're starting to see manufacturing come back now. We are starting to see some of the manufacturing starting a little bit to come back. I mean, throughout the past couple of years.
Well, you see, the problem with the manufacturing coming back, though, is there's a cost-benefit analysis. So what's going to happen there, price is going to go up, because there's no way that we can manufacture in the United States what we're manufacturing abroad, or else we'd already be doing it in the United States.
Right.
So it was an apples-to-apples comparison. The reason we're manufacturing things abroad is because there's more efficiencies, and we can get them at a cheaper price. So, you know, just go down to the local strip mall, you know, the area we were talking about when I used the example of going to lunch yesterday. Look at what all the businesses are. They're all service-oriented. They're all restaurants. They're all bars. They're all cafes. And even if they sell a good, the goods that they're selling are made in China.
Right.
If you go to Target, if you go to Walmart, if you go down to your local car dealer, you can go down to your local Ford dealership, and a large percentage, or a significant percentage of the parts that are in that Ford are made overseas. They're not made here in the United States. And to the point where you couldn't make Ford trucks if you only had parts sourced in the US. So the costs of all those things would go up. And that's if, this is a big if you could actually bring the supply chains back into the United States. So you say, okay, George, well, why would that be a problem? Well, first and foremost, you've got regulation issues.
Mm-hmm.
I mean, how many, the regulatory burden and hurdle that we would have to overcome here in the United States, is that even possible, given the current and what I would consider the future political environment and social narrative? I would argue probably not. And then you've got to look at capital. And yes, there's an excess in capital going into the stock market, chasing financial assets right now, but there's definitely not an excess of capital wanting to go into creating a manufacturing plant in Illinois or in Oregon or California or Washington. And you got to put yourself in the position of that person. Let's say someone comes to you and says, you know what, I've got this great idea. We're going to start manufacturing plastic toys to be sold at Walmart. And we're going to set up our manufacturing plant in Seattle or Portland, Oregon,
Okay.
or really anywhere. And you say, what we need from you is $1 billion. And all you have to do is give us this $1 billion. And we're going to try to set up this plant. It's not going to be up and running for 5 years. And then you're not going to get your investment back for probably 20 years. And that's if everything goes right. And also that's if taxes stay at the same rate they are now. But in 20 years, if everything goes perfectly, you might get a 10 or 15% return on your money.
That
You're going to be like,
great, doesn't it?
Yeah, you're going to say, hell no, I'm not going to do that. That's nonsense. With $1 billion. So if you would think that, then pretty much everyone else would think that as well. So I don't know that there would be the capital, that the appetite for risk would be there with that capital required to set up the manufacturing supply chains here in the U.S. I don't know that from a regulatory standpoint, that it could be done either. And I think that, especially if Biden gets in office, and I'm not here to say one's better than the other. I like both parties, or I dislike both parties equally.
Great.
But the bottom line is, just calling a spade, if Biden gets in, the chances are corporate taxes will be going higher, and we'll see an increase of regulation on businesses, on large, mid-sized, and I'd say even small businesses. So if we have an environment that has ever-increasing regulation, then capital is always going to go where it's treated best. And that means probably away from the United States, especially when you have this social narrative that really revolves around socialism and Marxism.
Yeah.
And, let's look at the Black Lives Matter movement. And I'm not here to say that they don't have good intentions or whatever. But if you look at the way, if you look at kind of what they're trying to achieve and their objectives outside of the racial issue, it's all very Marxist. It's all very, I shouldn't say Marxist. I should say it's very anti-free market capitalism.
Okay.
And so whenever you have an environment that is anti-free market capitalism, and we're in the trajectory from a societal standpoint is moving more and more and more in that direction, and you combine this with what we were talking about from a political standpoint and a regulatory standpoint, it doesn't bode well for future investments in CapEx and in research and development and building these giant, plants that are really intensive and can't be moved. Like if you build your $1 billion plant in XYZ state, it's not like you can just say, oh, well, we'll just take the plant and move it over to Mexico or somewhere where there's not as heavy duty taxes or regulation, or where the rioters aren't trying to blow it up every 10 days or start on fire or something like that. You can't do that. So I don't know. I don't know. I see that, yes, the United States is a good place to invest in certain businesses, but I would argue that they've got to be more service-based. Therefore, if they're not manufacturing, we're going to continue to have an economy that's completely dependent upon consumption, dependent upon foreigners
making all the goods that we're buying. And we're not going to get away, or I don't think we're going to get away from that over the next 5-10 years. And unfortunately, I think the only thing that changes that is if we do lose the reserve currency status and the costs of importing all of these goods goes so high that we don't have the choice but to bring that manufacturing back to the U.S. and to reduce regulation and to do anything that we can to incentivize more capital coming in and more investment. And unfortunately, I think we've got to go through a lot of pain before we get to that point.
Right. Real quick, because I know your time is somewhat limited. How is your phone? Is your phone okay as far as overheating?
Oh, yeah.
Okay.
Yeah.
I got really one last set of questions I'd like to ask you. And then if you're game for it, I'd like to do another follow-up sometime to ask some other questions. But we just recently, over the weekend, had that congressional report come out that was talking about a bunch of banks laundering trillions of dollars. And then it affected the futures market on Sunday, obviously. And when the markets opened up on Monday, it hit everything. I'm involved in crypto. I invest in silver. I do try to buy gold, but everything got hit. And then I see the kind of the other side, the writing on the wall with the Banking for All Act. So I'd kind of like to get your combination of your thoughts on what happened with the congressional reports where now finally it looks like maybe some of these criminals actually might get in trouble for doing something they're doing. And then also with where we're headed with this Banking for All Act, because I'm kind of thinking some of these banks that got indicted or possibly will be indicted could be taken out. And then with the idea of the Banking for All Act, everybody will be getting Federal Reserve bank accounts. So it's kind of like almost like a replacement in a way. I don't know if you thought about that or if that makes any sense.
Yeah, for me, I think that these banksters are incredibly shady. I think that's just the way it goes.
That's nice. You're being really nice to these bankers.
Yeah. That's a nice way to say it. That said, I've got a lot less confidence in politicians than I do in banksters. Maybe they're equal. So if I was a politician and I was trying to engineer a way for people to stop using cash and for people to voluntarily set up an account with the Fed, in which case I'm going to have access to every single transaction they ever do for the rest of their lives.
No privacy.
Yeah, no privacy whatsoever.
Complete surveillance.
And not only that, they can just come in and extract whatever they want when they want without any due process.
Right.
And so, how do you get the general population to go along with that? Well, one way is to reduce the confidence that they have in these big banks. So I don't know. I'm not saying that the banksters didn't do anything, but I wouldn't put it to the politicians to set them up either.
No, exactly. The pot calling kettle black.
Bottom of the barrel.
The pot calling kettle black, totally.
The dregs of our society, really. But I think more importantly to your question, it's inevitable as far as them banning cash, them then going to a form of Fed coin, if you will, and us all having to have accounts at the Federal Reserve or an account somewhere that can be monitored and they can control the money supply more efficiently, and they can control the velocity of money. So yes, you're absolutely correct in talking about the lack of privacy, but this would also allow the Fed or the Treasury or whomever to inject currency units directly into the economy. So right now the Fed can create a quadrillion bank reserves, but does that actually filter out into the real economy? Maybe, maybe not. There's no direct mechanism. But if they had these commercial accounts of every American or every adult on their balance sheet, then they could affect these things. And then you say, well, how do they look at velocity or how do they control that? Well, you could just have an app on your phone, in which case they give you like UBI every single month of these
Fed coins. Let's just say $2,000 worth of Fed coins. But you'd have to download the app onto your phone. And as you download the app onto your phone, that automatically sets up an account for you at the Federal Reserve Bank. And so then you got this $2,000 on your phone. And so now they've directly increased the money supply, broad money, or money in the real economy. And then what they could do is say, okay, you've got to spend it within 30 days, or else it's gone. Poof, it doesn't exist anymore. So that's a way, and if the velocity wasn't high enough for them to create inflation, then they could just say, okay, now you got 20 days, 10 days, 5 days. And at some point, you're going to get velocity extremely high, and you're going to create enough money supply to really create as much inflation as you want to create to wipe out the debt of the federal government. And I think that then they'd have direct access to the tax receipts. Remember at the beginning of the conversation, we were talking about inflation only being beneficial to the government, reducing their tax burden if the tax receipts increase. Well, now you've got a way that everyone has their account with the Fed, so those taxes could be extracted from your account as you spend the money. And so Americans don't have a lot of experience with this. Let me give an example of my broker in Colombia, the country, not the city here. Mm-hmm. So I've been investing in real estate in Colombia, and Medellin more specifically, since 2015. And what happens, let's say I send down $500,000. Well, then they transfer it into pesos. So now I've got the equivalent amount of pesos in my account. Well, if I go and I buy an apartment, let's say that I want to remodel for $400,000, and let's say I've got $100,000 in there that I'm going to use for the remodel. When I spend the $400,000, they automatically tax it as I spend it. You see, they, meaning the brokerage, they're responsible for taking out almost what is like a sales tax.
Right.
Right. And that goes to the central bank. Now, what this is it's a tax to where you're prepaying the amount of interest that they assume you might have made by having that $400,000 sit in the account for, call it, 6 months. Let's say you're making a 5% rate of interest. And so then they're saying, okay, well, we're going to, and the tax rate, I believe, is like 0.4%, something like that. So they tax 0.4% of the gross that you spend out of the account, no matter what it's on. It doesn't matter. And then at the end of the year, when you file your taxes, you pretty much settle up. So you're almost like prepaying capital gains tax.
Right.
You see? And so why couldn't they do that in the United States, where they not only have a sales tax, but every time you buy something, you have like a 0.4% or something like that would go against either future capital gains tax for the remainder of the year, or would go against income tax or anything like that, almost like a withholdings tax from your income, from your paycheck.
Right.
But they could just do it on the other side, where they tax the spending as well. And at the end of the year, it's up to you to settle up. So then what they could do is they'd have control over the amount of money supply, or they'd have total control of the money supply in the real economy, chasing goods and services, and they'd have control over the velocity, and to a certain extent, they'd have control over the tax receipts that were generated as a percentage of the overall income and capital gains. They'd have much more control over it. The one thing they wouldn't have control over is the supply of goods and services.
Right.
And that's a whole other ballgame. And that's, ironically, is what is most important.
Well, do you think that, you don't have to go into a long answer because I know we're getting ready to wrap up, but do you think that if they were to pass the Banking for All Act, go cashless, digital, that we're going to be able to not have a collapse, not have the pains of of everything that's occurred this year? Or are we still is the economy still going to be hit by this ultimately, regardless?
Yeah, we're at the point of no return.
Okay.
The economy structurally is unsound. And if you have an unsound economy, there's no way to really fix it unless you were just to dramatically reduce taxes and regulation, all the things, do the opposite of what we talked about before. But
right.
The the likelihood of that is almost zero. So yeah, you're going to have to go through some pain. And I think that kind of the end game, the way this plays out, there's no certainties, there are only probabilities. But my base case would be that we go cashless, we all have accounts at the Fed, and they go to this Fed coin to try to increase the inflation. And then the first year or so, we don't see a dramatic increase. We don't see the 1970s. So now all of a sudden people think that inflation is dead. We can never have inflation again. It's something that was just part of the past, and we never have to worry about it. So then what they do is they say, well, if we're never have to worry about inflation, then why on earth are any of us working? Why are we paying taxes? Right? Why don't we just print the money and have all these foreigners provide us with all these goods? We'll just give them these green pieces of paper, and we'll just sit on the couch and watch TV and never have to.
That's what we're doing, isn't it?
Right. So that UBI that I was talking about goes from 2,000 to 5,000 to 10,000, and then all of a sudden, the inflation genie comes out of the bottle.
And then you got a reevaluation or something like that.
Then you're toast.
Yeah.
Because you can't get her back in, because increasing interest rates would crush the economy far worse than COVID, in my opinion. And so that's off the table. So then the only other release valve is the dollar, and that's what takes us to 1970s. That's what, and even beyond. I mean, a lot of people would argue that's what would take us to hyperinflation. And I'm not talking about tinfoil hat guys like me, and these, and maybe people might throw Schiff into that category. I wouldn't, and Schiff's a great guy. And
I like him for the gold.
Peter.
I like him for the gold. I don't like his closed-mindedness with Bitcoin and stuff, but
yeah, but just for your viewers, just FYI, what you hear on his podcast is what he believes. That is honest Peter. A lot of people think that he just kind of talks his book and stuff. He doesn't.
No, it's his life. I know it's his life.
Yeah,
I mean, overall, I got respect for him, especially like when it comes to like analyzing the gold and silver markets.
Yeah, and I'm not saying he's right or wrong about Bitcoin or crypto or anything like that. I'm just saying that whatever you hear him say is what he truly believes. And I can vouch for that just by talking to him on the phone. And even now that we've talked on the phone and we're friendly, if he hears me on a podcast saying that I like Bitcoin, I'm going to get a text.
That's great. Well,
what
Peter,
are you talking about?
If you see this, Peter, I definitely would like to interview him one day. That would be an experience.
He's awesome. He's awesome. I can't say enough great things about Peter. But my point is, I think the end game there could definitely be hyperinflation. And people like myself, Peter, have talked about that. But a lot of people that are right in the mainstream that are incredibly respected, guys like Dr. Lacey Hunt, have said the exact same thing. He's a deflationist right now. But he says that if the Federal Reserve takes bank reserves and those become legal tender, which is just basically a fancy way of saying that talking about the process we just explained. Mm-hmm. He said I would immediately go from a deflationist not to an inflationist, but a hyperinflationist. And he's using the term hyperinflation. That's not me. Right. So I think that would be kind of my base case for an end game. And it's not to say that it happens overnight or in 3 years, or you've got to run out and buy Bitcoin or gold tomorrow, because if you don't, your purchasing power is going to evaporate. But all these things are usually kind of a gradual. They happen slowly, then bam, kind of all at once. So I see that maybe playing out over the 5-year, 10-year term.
Okay. Very cool. Well, again, man, I really appreciate your time. I'm going to have links down below for your website, for your YouTube channel. And if anybody's not already subscribed to your channel, I would definitely encourage them to do so. Before we do wrap up, you got any final thoughts? Anything you want to leave people with?
No, just go out there and try to be as educated as you can. Listen to podcasts and YouTube channels like this one or mine or Lynette's or Rethinking the Dollar, Bitcoin Ben, or Schiff, or anyone we talk about. I always encourage people to watch Macro Voices or listen to Macro Voices in Real Vision if they have the opportunity. And just to get a better understanding of how this works. There's no downside to it at all. And if you better understand what is happening now and what's happened in the past, you'll have a better way of predicting the future and making better decisions to make sure that your financial future is as good as it can be for you and your family.
Well said, George. Well said. If you could bear with me 1 second, I want to wrap things up. Ladies and gentlemen, again, I'm going to have links down below for everything we talked about. If this is your first time ever watching any of my videos, I do encourage you to explore my channel. Make sure you subscribe, smash that like button, hit the notification bell if you want to stay up to date with my videos as they come out. Be sure to check out my Patreon channel where I post up exclusive content, and it's a way to support what I do directly. Also, if you're interested in buying some silver, make sure you're checking out moneymetals.com. And if it's your first time buying with Money Metals, you use the promo code RICE and you purchase over $100, you'll get a free ½ ounce of silver. So definitely take advantage of that. George, again, I thank you for your time. I look forward to conversating with you again in the future. I want to stop recording. Ladies and gentlemen, as always, I encourage you to be the change by practicing change.